When valuations are crazy, and we can use the word crazy at this point, because when we look at the valuation of value stocks versus growth stocks, we're at a 4 standard deviation outlier. That's more than what we saw during the top of the dot-com boom. Okay,
we're still at that spread.
Well, we've
today.
come down a little bit, but we just peaked maybe about 3 weeks ago, and so valuations are truly crazy. So no one's talking about rising interest rates anymore. I know interest rates are a little bit down today, but if we look, from just like 18 months ago, interest rates have doubled. When interest rates doubled, that's like the giant sucking sound of cash coming out of the economy. When you take that much cash out, bubbly valuations, they can't last. So they can't last in tech stocks. They're not lasting in art. If anyone's following the art auctions last week, big prices made headlines, but everything underneath those big prices didn't work. If you look at luxury goods, if you look at luxury real estate, all those prices are falling, and it's all the result of super high valuations deflating as all that cash gets sucked out of the economy as we adjust to a higher interest rate environment.
So there's no opportunities in equity markets?
There are always opportunities. So let's go back and look at the dot-com boom. What happened during the dot-com crash? Value caught up, international stocks caught up. That's when we had the big run in EM. And so right now, while we don't necessarily believe that you can time factors, we're definitely tilting away from momentum stocks, which are getting hammered, and we're tilting towards value stocks. You'll find safety in value, and you'll find great return in value as we come out the other side. But it could be a while before we come out the other side.
So it sounds like you think that U.S. equities have farther to fall, and it also sounds like, correct me if I'm wrong, that EM looks like a buying opportunity.
I think if you look at the major market indexes, they're so overweight technology. And if you just look at Europe, for instance, Europe doesn't have big technology names like the US. And so a lot of the underperformance of Europe and Japan versus the United States is just tech. It's the same story as value versus growth here. And so, yes, I think if you look at emerging markets, if you look at Europe, if you look at Japan, a lot of the headlines are pretty negative, but underlying that are solid earnings, there's stable growth, and I think ultimately that's where the returns are.
Jim, if we compare, though, back to 2007-8 period, lots of people then said, oh, buy your strong cash flow, your dividend-paying stocks, they should be relative outperformers. They were relative outperformers, but you still lost money over a year and a half period. So again, does that apply now? If you're really bearish, like it sounds like you are a little bit, should you not just buy puts on the market, for example? I mean, what's the true protection here from losing money at all, rather than just relative outperformance?
There's no way to avoid losing money at all. And there was a really wise investor that once told me that bears always sound really smart, but bulls always make more money. And so getting out of the market, trying to time the market's a really, really terrible way to manage the portfolio. That said, I think being a little bit more defensive by going into value names and going into some of the parts of the market that just look a little bit less expensive, it's going to protect you on the downside and set you up for that rebound. And so that's really how we're positioning the portfolios for our clients.
And you're staying defensive for the rest of this year, for sure.
Definitely staying defensive.